And good afternoon. Welcome into Market Talk for this Friday, February 26th, 2021. Good afternoon. I'm your host, Jesse Allen. Great to have you here with us. MarketTalkAg.com. That is our home on the web, MarketTalkAg.com. Find us on Facebook, Twitter, and Instagram. It's all at Market Talk Ag as well. And you can find our radio affiliates on our website. All the streaming sources we're available on, including Apple Podcasts, Spotify, iHeartRadio, and many more. You can find it all on our website, markettalkag.com. Well, we round out the month of February's trading with another down day in the markets, grains, livestock, and the outside macro markets. It was pretty much red across the board. Let's talk about all of it and see what's going on. Let's bring in Kent Beadle with CHS Hedging joining us here today on Market Talk. Kent, good afternoon. Great to have you back on the show.
Yeah, well, thanks for having me. Really appreciate the opportunity to be with you and your viewers.
Yeah. Kent, I always enjoy your insight and really, I think a good time to have you on, even though the markets were lower today and were lower
Yeah.
the last couple of days. But, we're getting to the end of the month of February, and I think there's a lot of interesting factors playing into this market trade right now. Overall, here as we wrap up this week, what did you make of all the weakness that we saw?
Well, first of all, you got to keep in mind that the weakness that we saw on Thursday and Friday was on top of a very strong start to the week. And in fact, we are closing higher in all of our, in both corn and soybeans for the week. I think we're up maybe a nickel or approximately that in May corn, up a dime in December corn, and maybe up a little bit more than a quarter in November soybeans. So yes, we were well off of our highs, but we had some macro issues that I think kind of came to the fore on Thursday and Friday. Yesterday, you had a big surge in treasury yields and interest rates, and that hammered down the stock market. That pushed down a little bit on our livestock markets. Some concern about this entire reopened trade, so to speak. Is that do we have that all priced in with the stimulus package in Washington and all of those things that are going on? I also would note, in just looking at trends in the COVID situation, that just these last couple of days now, we've seen this sharp decline start to level out, and actually the 7-day moving average in COVID cases has started to turn a little bit higher again. There's some worries about a variant in California, in the Bay Area right now, as well as some of these other variants. And is that going to be something that could derail some of that recovery trade? And then, I think the other thing is you just got to some levels where you probably saw some farmer interest in pulling the trigger on some additional sales. And, we had, you've got that situation combined with what was not a great export sales report yesterday morning. And, you started to trigger some profit taking. And in a good bull market, you're going to have a lot of these. I think this is corrective. I don't think that we made a high. I would concede that on the May soybean chart specifically, you had an outside key reversal lower, got some follow through today. We were down 20 cents at one point in the session. But keep in mind, we only closed May beans down 3 1/4. Okay. That's a bit of a recovery and a pretty good solid close, high range close for the day, and that continues to make me think that a lot of this was corrective. I go back to last week's USDA Outlook conference, and I just have to say that the numbers that they gave us were extraordinarily important, because essentially they told us that both the corn and the soybean balance sheets 1 year from today are going to look very similar to the balance sheets that we have today, assuming and that has a lot of assumptions in it, but If you look at the acres that they gave us, 92 million corn and 90 million beans, I thought that those were pretty good general numbers. I know there are some people who think those numbers could grow, but I'm not sure that they can. I certainly don't think they can if we don't have even higher new crop prices, because essentially to get more acres into corn and soybeans, you're going to have to bring marginal acreage back into production. Costs are high right now. Fertilizer is soared. Energy prices are more expensive. And obviously, when you bring a marginal acre back into production, you can't pencil in the same type of yield. So, the truth is that those marginal acres don't pencil nearly as well as the acres that we have currently. That's why I think the USDA acres numbers are good. Their yield estimates were, trend line. And of course, trend line these days means record or near record, right? They're printing a record yield in corn.
Yeah.
And we're not going to add to the balance sheet, and we are really tight. And of course, those new crop contracts are heavily discounted because that's one of the functions of the market right now, is to be inverted in order to incent all of the bushels that are in producer storage and commercial storage to be moved in through the commercial chain this year. Because quite frankly, both corn and soybeans, soybeans statistically, but corn realistically, is that they are both at pipeline minimums. I say statistically for beans because 120 million bushels, is pretty clear. Stocks to use ratio is the tightest in history. In corn, I say functionally, or it's likely because the export estimate that the USDA has given us is going to have to go up. Okay, it's very, very likely to go up. I mean, granted, we've got unshipped sales on the books to the Chinese, but if you look at Chinese prices, there's every reason to think they're going to be shipped. We've got 6 months to go before. And we before the end of the marketing year, and we only have 10% of our export estimate to achieve. And there's a lot of just regular old nearby demand from places like Canada and Mexico and potentially Europe, non-Asian destinations that are easily going to make up that difference. So, we think the carryout's closer to 1.2, which makes next year's balance sheet closer to 1.2 in corn. And that just means that when you have these corrections, that's just what they are, because the last thing this market needs right now is to go and drop to prices that either A, discourage some of those acres to come into production, or B, to encourage additional demand. That is not what the market needs right now.
Definitely, I think you very well summarized everything going on in this marketplace, and I'm glad you mentioned there at the beginning that we did close higher for the week. I think that's an important storyline we don't want to forget. And the way we closed today, we did rally back in corn and beans. Didn't touch on weather in South America a whole lot, and I know that we're starting to hear. Well, it seems like the forecast changes every day down there.
Sure.
The last week or so, and we were starting to hear that maybe some of that product out of Brazil and Argentina is starting to get shipped to China. What are your thoughts on how much that situation in South America is going to play into our markets here as we move into the month of March?
Well, so it's a fact. It was always going to be a fact, right? Eventually, the Brazilian crop was going to get harvested. We're turning the calendar into March. They are behind, but over the next 30 days, unless it just keeps raining, an awful lot more of that product is going to be available. And as that happens, those are the bushels that are going to work into China. That's fine. That's exactly what's supposed to happen. Okay. Here again, with soybeans specifically, we have sold approximately 90 7% or thereabouts of our actual sales estimate, and we can't actually afford to sell them anymore soybeans. If we do, and quite frankly, I think that our export estimate in beans is going to go up anyway. We're going to have to turn it back around on the other end and actually get some of those soybeans out of Brazil imported into the U.S. Okay, so I talk about functions of the market, and that first function to have an inverse to incent all of the bushels to move. Okay, well, another function of the market is likely going to have to be able to have a price in that July-August portion of the curve that economically allows for some Brazilian beans to ship to the U.S., either offload at Wilmington or potentially offload at the Gulf and be barged up the river into some crushing plants. Because if that doesn't happen, we don't have enough meal to feed the hogs and the chickens. Okay. It's interesting. Last year, Brazil actually oversold their supply situation, and they had to take a couple of cargoes from the U.S. Now that's going to turn back around, and it's going to go back in the other direction here this year. It's just not a surprise, and it should be expected by the market. Now we get a little bit, crazy when we hear that might happen, but it's what's going to happen. And quite frankly, we don't think that the prices out in that part of the curve are actually getting that job done yet, or going to get that job done yet. One other point I would make about South America, and that is that some of the estimates are starting to grow. I think it was last Friday, actually, that Informa raised their estimate from 133 to 136 for Brazil. We follow Dr. Michael Cordonier. He's still at 130, but he's kind of gotten a neutral bias now, and he used to have a neutral to negative bias. And he would say that if it stops raining, that number might go up 1 million or 2 million tons. USDA is still at 133. I honestly think that these additional bushels, we need. Marketplace going to need them. Because again, you start looking at these balance sheets, and they're just really tight. And there's always, of course, the one big thing that kind of hangs over our head, is always going to hang over our head, and that is what are Chinese true intentions? Okay, number one, are we working beans into their crush, or are we working beans into their reserve? Right. And if we're working beans into their reserve, at what point do they say, well, we've got enough? And what are the political ramifications of everything that's going on with the relationship between the United States and China? I'd love to be able to tell everybody that we know the answers to all of these questions, and we don't. But the best thing to do is look at Chinese behavior and Chinese prices. And right now, the Chinese behavior is that they want to buy, and they have been buying. And we're at that inflection point where they're not going to buy from us for a while. It's okay. But they have been buying. They already have a large new crop book on. And then the other piece is, what are their prices? And Chinese prices are still very, very high, both corn and soybeans. We still pencil out good crush margins in China. And interestingly enough, by the way, crush margins here in the U.S. have been starting to improve as well. So, we went from over $1 a bushel on a board crush down to, 55, 60 cents. We're back up with the front month up over 90 cents again. So, the marketplace needs us, as we're losing part of the Chinese market, and we don't have a lot of beans left, the domestic crusher still wants soybeans here.
Sure.
And,
yeah. You mentioned earlier how you don't think we made the highs yet, and obviously, we're getting some of these corrections into this bull market, which is needed and expected. Any advice for producers right now as they're looking at their marketing plan here? Corn, soybeans, wheat, whatever it is, because we know there's still great price levels out there, a lot of room for profit. Any advice for producers here as we move into the month of March?
Well, make a plan. Whether you're working with an advisor or whether you're handling it yourself, make a plan, stick to the plan. Make sure that the plan is based on solid returns to your operation. And this is a year where you're going to be able to pencil those returns in. Um, I would add to that you may want to take a really good look at crop insurance situations this year and whether or not supplemental coverage might work out for you this year. Um, Hearing a lot of our clients that are talking about possibly buying up their coverage a little bit with that supplemental program. There's a couple of different types of programs out there, and I am not an expert in crop insurance. However, that is another way to assure a floor.
Mm-hmm.
And then go out and execute. Now, as I said, I don't think we've made our highs yet. However, we will be scaling in sales, and we've already scaled in some sales. We're at 20% sold for new crop right now, and we're going to be making additional sales going forward. We did own some call options against those sales, and in the case of corn, we've actually owned a few additional calls. And so, if you're uncomfortable scaling up into a marketing program, you might want to buy some calls at the outset just to make those sales a little bit easier. Go up out of the money, don't spend a lot of money, but and then between here and that strike price, start scaling your sales in. That's what we plan on doing. And again, essentially, we've already started.
Mm-hmm.
So make a plan, stick to it, make sure it's a plan that works for the financial growth of your operation. That's my advice.
Great advice. Let's move to livestock here. I want to talk this hog market. I think a lot of folks are starting to wonder, have we topped out in this hog market? And I know to round out this week, we've kind of lost, we kind of disconnected between cash futures, the cutout.
Yep.
We just, it seems like the market's maybe signaling we've hit a top here, but I still think there's a lot of skepticism on that. What are your thoughts on this hog market?
Well, I think that what happened here late in the week is not all that unsimilar to what happened in the grains. Okay. And as I said at the outset, we have some of these macro factors going on with, concerns about the equity markets and concerns about COVID and concerns about the, this reopening sort of macro play that has helped support our hogs. The cold storage numbers obviously were friendly, but we sometimes those things are priced in, and you end up getting you get some corrective activity. The truth is that our futures markets are sitting well above the cash right now, and when you have a day or a couple of days like this with the dollar today up sharply and what seemed to be just profit taking across the entire commodity spectrum, it's not surprising that after the kind of move that we've had in hogs, that we would see some profit taking there as well. So honestly, as I look at the summer months, and we take a look at June, July, August hogs that were in mid to starting to approach the high 90s. One of the things that we've taken a look at is history with high grain prices, and some of these years, back in the early part of this decade, so 2011, 12, 13, 14. Where did we peak out our summer hogs in those months, in those years where we had fairly expensive corn, fairly tight feed situation, and we just flat out we did manage to trade occasionally above $1 a pound, $100 a hundredweight, but it just we didn't do it for very long, and we didn't stay there very long. So as we run our crush calculations, using current corn values, and those summer months, while they're not the most profitable summer hog months that we've ever seen, they're still reasonably profitable. And between here and $100, I certainly think that hedgers ought to be thinking about getting some protection.
Let's move to cattle here before we wrap things up here today, Kent. And this cattle market's been pretty slow the last couple of weeks. I think that record cold going into the south really has had a lot to do with it, and the snow and ice and
Yep.
all the disruptions down in Texas, Oklahoma, and feedlot country down there. It just seems like this cattle market, like I said, slow, kind of sluggish, not wanting to really move anywhere. I know we had disappointing export sales numbers, and I think it's kind of the same factors on the macro side playing into cattle here as well. What are your
Yep.
thoughts on this cattle market?
Well, one of the things that we did today, of course, is we expired the February contract, and there's a lot of front end inventory here that has been kind of backed up and trying to move through the system. For 2 or 3 weeks now, our cattlemen have been, quote unquote, complaining to us about the spread between cash and the futures. And you've got cattle hedged for movement in this time frame, and you've got a board at 117 or 118, and they're only getting bid 113, 114 in the cash, and it's just, it's kind of frustrating. The market kept assuming that those discounted cash would find a lot of demand, a lot of help from end users, and it probably should have, and we probably should have seen the cash improve last week and this week, and we should have seen that cash climb into that 116 to 118 area. But last week's weather did exactly what you said, which was to slow everything down, to create some problems in the packing industry. And I think there was still some optimism from the trade that we were going to get some higher cash values, and it just didn't happen. And so lo and behold, we end up down nearly $4 today on the very last day of trade. And that weaker February close certainly had an impact on all the future months as well. It pulled down on that April contract and on the June contracts, and we saw a little bit of weakness there. I think that is more corrective in and I still actually do believe in the sort of recovery trade, the post-COVID trade. I do believe that the American consumer is got freezers full of meat, and where we don't have our supply is in the restaurants and in the hotels and in the stadiums, and that we're ultimately here this summer going to see things open up, and that's going to drive an awful lot of demand. Like I said, I'm a little bit concerned watching the COVID trend and seeing that 7-day moving average turn up a little bit, and I think that has had a little bit of a psychological impact, even though it's not really being talked about. I think it's had a psychological impact on the stock market this week, and probably on the cattle market these last couple of days.
Well, Kent, great insight as always. And I know if producers need a little bit of advice, need some help, they want to work with you and the team there at CHS Hedging, very easy to do that. They could just reach out to you online or with a phone call, can't they?
Yeah, online at www.chshedging.com. We work with producers in our Ag Shurian program. Click on the Ag Shurian link and you can read more about that there. Otherwise, just give us a call, 800-328-6530 or 800-851-7892. So,
yeah. Kent, I always appreciate you joining the show. Thank you so much, and look forward to having you on again in the future. And until then, have a great weekend, and we'll talk soon.
Yeah, great. Thank you so much. Appreciate your opportunity to be on again this week.
Kent Beadle with CHS Hedging, our guest here on today's edition of Market Talk for this Friday, February 26th. Find us online, markettalkag.com. I'm your host, Jesse Allen, wishing you a great rest of your day and a great week.